$100 gain, you feel amazing. $100 loss, you feel twice as bad. Same size, totally different pain. This asymmetry is loss aversion, a core force in behavioral finance and money psychology, shaping everyday financial decision-making and market psychology. So when things go wrong, we tend to blame ourselves less than we would praise ourselves for similar successes. And this effect compounds in markets. If you're down 20% on a stock, it'll take a 25% rebound just to break even. And that feels psychologically different than if you're up 25% and need a 20% pullback to feel the same. Prospect theory from Kahneman and Tversky formalizes this idea. We judge outcomes relative to a reference point. And for losses, the value curve is steeper than for gains. This explains why investors fear losses more than gains, and why smart people make bad money decisions despite the math. Cumulative prospect theory adds decision weights under uncertainty. We overweight small probabilities and underweight big ones. So we overpay for lottery-like payoffs and overinsure vivid tail risks. These distortions feed emotional investing and cognitive biases in trading. In portfolios, this shows up as the disposition effect, selling winners too soon and holding losing stocks too long, turning portfolios into museums of mistakes. Sunk cost fallacy and the endowment effect keep us attached to losers, while confirmation bias hunts for comforting evidence that a rebound is near. Overconfidence bias makes us think we can time the turn. Herd mentality drags us with the crowd, and recency bias makes the latest drop feel like destiny. Housing markets echo the same psychology. Anchored to the purchase price, sellers facing a paper loss set higher asks and wait longer, because the old price feels like truth. That's anchoring bias tied to a salient reference point. Myopic loss aversion explains why frequent checking shrinks risk tolerance. Short-term red is more available to memory via the availability heuristic. So loss salience spikes. Equity exposure falls and long-run returns suffer even though expected returns favor staying invested. Put simply, how cognitive biases affect money choices isn't abstract. It changes what you own, when you trade, and whether you reach your goals. The evidence base is broad across investment psychology. Brokerage data document that investors prefer realizing gains over losses and that trading more, often driven by overconfidence, hurts returns versus simple benchmarks. Housing data show loss-averse sellers list higher and sell more slowly. Retirement savers who check too often hold less equity, consistent with myopic loss aversion and mental accounting that frames each statement as a fresh win-loss record. Still, limits and debate matter. Meta-analyses report wide variability in loss aversion estimates, and some critiques argue losses loom larger is not universal. Context, stakes, and measurement shape how strong the bias appears. That nuance doesn't cancel the pattern. It tells you when it bites hardest. Emotionally charged, ambiguous, fast-moving settings with frequent feedback. So how do you overcome loss aversion in investing without pretending to be a robot? First, pre-commit rules before emotions arrive. Specify position sizing, entry criteria, and both exit points. Take profit targets and stop-loss levels so you aren't negotiating with fear later. Second, reframe from trades to portfolios. Use mental accounting wisely and evaluate over a longer horizon so one red position doesn't dominate judgment. Judge results at the portfolio level, not trade by trade. Third, reduce noise exposure. Schedule monthly or quarterly reviews instead of constant checking to dial down myopic loss aversion and align risk tolerance with goals. Fourth, build an evidence checklist to fight confirmation bias. Write the strongest disconfirming reasons, consult base rates, and define what new information would invalidate the thesis. Fifth, use implementation aids that separate intention from action. Automatic rebalancing and model portfolios systematize buy low, sell high, and buffer herd mentality in panics. Sixth, practice stop, swap, or size. If the cash were free today, would you still buy this asset? If not, swap it or size it down. Don't let the endowment effect and sunk cost fallacy trap you. Finally, train probabilistic thinking. Translate fear into explicit scenarios and odds to temper decision weights and reduce availability-driven overreactions. The long-tail questions people actually type: loss aversion in investment decisions, how cognitive biases affect money choices, overcoming fear of losses in investing, behavioral finance tools for better decisions, psychological traps in financial planning, are not SEO fluff. They're a daily operating manual. Audit your own data by comparing sell decisions against a simple hold or index benchmark to see where cognitive biases cost investors money. Loss aversion is powerful but not a prison. Design beats discipline when markets get loud. Evidence first, money psychology.